Ebitda, earning before interest, taxes, depreciation, and amortization.
What is Ebitda?
Ebitda, short for earnings before interest, taxes, depreciation, and amortization, is an alternate measure of profitability to net income. It's used to assess a company's profitability and financial performance. Ebitda is not a metric recognized under GAAP. Some public companies report Ebitda in their quarterly results along with adjusted Ebitda figures, typically excluding additional costs, such as stock-based compensation. Increased focus on Ebitda by companies and investors has prompted criticism that it overstates profitability. The U.S. Securities and Exchange Commission requires listed companies reporting Ebitda figures to show how they were derived from net income, and it bars them from reporting Ebitda on a per-share basis. If a company doesn't report Ebitda, it can be easily calculated from its financial statements. The earnings, tax, and interest figures are found on the income statement, while the depreciation and amortization figures are normally found in the notes to operating profit or on the cash flow statement. There are two Ebitda formulas, one based on net income and the other on operating income, both of which will arrive at basically the same result. The respective Ebitda formulas are: Formula 1. Ebitda equals net income plus taxes plus interest expense plus depreciation and amortization. Formula 2. Ebitda equals operating income plus depreciation and amortization.
Why a company calculates Ebitda, and who needs it?
Ebitda is calculated mainly for the investors. When comparing two companies, the enterprise value divided by Ebitda ratio can be used to give investors a general idea of whether a company is overvalued or undervalued. It is important to compare companies that are similar in nature, like same industry, operations, customers, margins, growth rate, etc., as different industries have vastly different average ratios. The metric is widely used in business valuation and is found by dividing a company's enterprise value by Ebitda. Summary of today's topic. 1. Ebitda is a measure of core corporate profitability. 2. Ebitda is calculated by adding interest, tax, depreciation, and amortization expenses to net income. 3. Some critics call Ebitda meaningless because it omits depreciation and capital costs. 4. The U.S. Securities and Exchange Commission requires listed companies to reconcile any Ebitda figures they report with net income and bars them from reporting Ebitda per share.